Most Indian employees, or even NRIs for that matter, have some amount of compensation received in the form of RSUs or ESOPs, because they might be working for a US company or a foreign firm. And most of them are unsure what to do with it, right? So some of them, they just withdraw the entire amount as in when it is vested. Some of them, they just keep it for eternity. Some of them, they just withdraw it whenever there is a need for cash, right? So the decision in most cases seems to be completely random without any data-driven decision. And in fact, many employees assume that whatever they have received in the form of RSUs or ESOPs is a free compensation, right? It's not like they have invested that amount of money into one particular stock. Now imagine this case. Let's say you've received the entire comp in cash and you haven't received any RSUs. Everything has been given to you in your bank account. Now, will you invest some part of that cash into one single stock? Will you do that? Is the question that you need to ask, right? If the answer is no, then you need to think about how you are going to invest, or how are you going to keep these RSUs, whether you want to withdraw some of it or whether you want to keep it. So we thought, why not put some science into the decision that we want to make here? And the key question that we are asking here is, would you like to be invested in one single stock, that is stay concentrated, or would you want to diversify into a more broader index or a portfolio of stocks, right? So in today's video, I'm going to take you through a very simple tool that we've created. It's hosted on west.factorlab.in, and I will add that link to the description so that you can clearly look at it. And it's also free to use. Anyone can just open the URL and start playing with it. And in a bit, I'll show you how can you use it yourself. So here is how it looks. So firstly, you enter the stock ticker for which you have your RSUs or ESOPs. I've put Amazon here because in the past I worked here in Amazon. And any benchmark, I've put 4 benchmarks here. One is S&P 500, NASDAQ 100. Both are US indices. And equivalent India indices, Nifty 50 and Nifty 500. For now, I'll compare it with Nifty 50 benchmark. And assume you put a corpus of, or you have a corpus of 10 lakhs into this stock or the benchmark. And let's say we're looking at a horizon of 10 years. And here we also have a factor, a most important factor, which is INR depreciation percentage. We've looked at the past data and made a rough assumption that the average depreciation is 3.5%. Here you can again tweak this number to your convenience and see how the results will pan out. Now we have bifurcated this tool into 2 parts. The first part will essentially look at the historical data. If we had invested in Amazon 10 years ago, what would be the value look like? How would the experience be for an investor who has put their money into Amazon versus how would the investor money look like if they put their money into benchmark like Nifty 50. Now you simply click on run comparison. It'll take a second to populate the figures. Now on the left you see what will your value look like if you had invested in Amazon 10 years ago. This is historical basis. So your value would have become nearly a crore. And the rolling return is probably a better metric to look at because it avoids any entry bias in the last 10 years. So 24% rolling return mean a volatility of 33%. Now, if you compare these numbers with a Nifty 50 index, you would have received about 30 lakhs, and that comes with a rolling return mean of 13.68%, almost a 10% difference between what you get with Amazon versus the index like Nifty 50. But it also comes with a reduced volatility of about 16%, right? So almost half of the volatility that you would experience with Amazon. And of course, the max drawdown would also be in those terms. So minus 54% max drawdown. So your investment into a stock like Amazon could wipe into half in some cases, whereas with Nifty 50, it can drop up to minus 38%. And the max drawdown or the longest drawdown is 525 days. And with Nifty 50, it is almost 300 days. And here is the 3-year rolling return on a timeline. You can see the yellow line is Amazon and the blue line is Nifty 50. In most cases, Amazon seems to be on top of Nifty 50. And you need to note this point that we've also considered INR depreciation here. So if I change this to, let's say, 4.5%, right, the value here would change, but the value here would not change because it's already denominated in rupee, whereas Amazon is denominated in dollar terms, right? So this is one thing that you need to look at. So that's also one reason that even though Amazon and Nifty 50 are growing in the same way, let's say Amazon increased by 2% and Nifty 50 also increased by 2%. But if there is a depreciation, INR depreciation of 5%, that adds up to the value that you have invested into Amazon. So yes, so Amazon seems to be on the top in most cases. There were cases where Nifty 50 also did well during 2023. Mind you, this is 3-year rolling return. There were cases whenever Amazon did well, I think it did extremely well. So you can see the big gap between the curves, the 3-year rolling return curves between Amazon and Nifty 50. But the difference between Nifty 50 and Amazon when Nifty 50 did well is not very high, right? And recently again, Amazon seems to have picked very well compared to the index like Nifty 50. And here you can see the different metrics, 3-year rolling return, mean, median, minimum, and also maximum returns. And in most cases, you see in terms of returns, Amazon did pretty well, other than the worst case scenario where Nifty 50 has beaten Amazon by 5 percentage points. And of course, this rolling return comes with commensurate drawdowns. And here you can see the blue line, which is Nifty 50, has much lesser drawdowns apart from the aberration here in 2020 during the COVID time. Apart from this, Nifty 50 has stayed very low in terms of drawdowns compared to a single stock like Amazon. And this graph is just to do a simple sanity check on what's happening with Amazon and Nifty 50 share price. So you can look at these share prices and see if this tool is actually using the right data when we are comparing these two stocks and benchmarks. Now, what we've seen so far is historical basis. Now, what we are going to look at is more like a forward simulation. So what I meant by that is we basically take a representative metric from the historical data for both Amazon and Nifty and do about 10,000 odd simulations to see how could the price trajectory go for both Amazon and Nifty 50. And that's exactly what we did here. So when you click on run simulation here, so for the same stock and Nifty 50, you can see how the simulations have panned out on a 25th percentile basis. So that means you can consider a 1 in 4 chance scenario or a bad luck scenario. Even in that case, you've seen that Amazon has done well compared to an index like Nifty 50. Apart from volatility or max drawdown, on a most likely experience, right, a 50th percentile basis, you see Amazon has beaten very comfortably, both in terms of final value and also rolling return, but it obviously came with higher volatility and max drawdown. Now we've compared Amazon with Nifty 50, an Indian index. Let's compare that with a more relevant index from the US, which is NASDAQ 100. So I've compared here Amazon with NASDAQ 100. Here the INR depreciation will impact both Amazon and also the value with NASDAQ 100. So I'll just show that to you quickly. So if I change this to 4.5, you see the value changing for both Amazon and NASDAQ 100. So I'll change it, I'll revert this back to 3.5%. And when you run the comparison, you see that the value that you get from Amazon and also NASDAQ 100 is very similar, about 95 lakhs with NASDAQ 100 and 97 lakhs with Amazon. And even the rolling returns seems to be very well in line, 23%, 23% here. But the interesting part here is the risk metrics. The volatility is much lower, 22% with NASDAQ 100 and 32% with Amazon. The max drawdown is also much lesser with NASDAQ 100, and even the max drawdown days is also higher, right? So on a 3-year rolling return basis, you see the blue line, which is NASDAQ 100, seems to be mostly on top of the Amazon curve here, apart from the initial years when Amazon did pretty well, but you need to really time the entry and time the exit if you have to really get great returns from a single stock like Amazon, right? So that's what this graph says, and whatever we've seen about the risk metrics in terms of drawdowns is clearly visualized here. The blue line seems to be mostly under the yellow line here, apart from the small aberration here during the COVID time. And we've looked at historical basis now. Now let's look at the forward scenarios as well. And here I ran again the simulation, the 10,000 simulations. And here you see in the worst case scenario, the index did well, NASDAQ 100 did pretty well. 12.4 lakhs in value and also a 3 percentage points improvement in 3-year rolling return, much lesser volatility, much lesser max drawdown, so less pain, and also the recovery seems to be faster, much faster with NASDAQ 100 compared to a stock like Amazon. And if you look at a most likely scenario, the median case scenario, you still see that the final value is almost similar. The rolling returns are also very close, And but even with annual volatility and max drawdown and longest drawdown, you see that Nasdaq 100 is doing pretty well, right? So, and lastly, looking at the best case scenario, yes, in the best case scenario, you might do well sticking with Amazon, a stock like Amazon, but like I said, you need to time the entry and time the exit so that you need to make the most benefit out of it. So this is how you can actually compare your own RSU stock or ESOP stock with an index, an Indian index and also the US index. Compare it in two different scenarios, the historical basis and also the forward-looking basis. Basically, you can determine whether you want to stay invested in that single stock or you want to stay invested in an index that gives you more or that gives you less sleepless nights compared to staying invested in a stock, in a single stock. So this is how you can do that, and I would encourage you to go to this link and try it out yourself with putting your own ticker there and see how the experience is going to be. Feel free to give me feedback on this tool. We're happy to add any important changes to this tool that will help you make this decision better. I think there are two more things that are still required for you to make a more meaningful decision. So one is how much you want to, so there is some amount of you want to still stay invested into a single stock. You don't want to obviously just pull out the entire money at once, but what is that percentage, right? So how much percentage should you stay in RSUs or ESOPs versus how much percentage you want to be diversified? So that's something we can answer through another interesting exercise that we're going to do later in a different video. And the second question, important question is when do you think we should actually withdraw some money into that concentrated exposure? That's again something that we will answer in a different video. Till that, stay tuned. Thank you.